Audit Committee audiocast test.
Test 1, 2. Okay, folks, we have quorum, so maybe we can get started on the May 28, 2015 meeting of the Audit Committee. If we could start, does anybody have any declarations of interest? Hearing none. Confirmation of minutes from our last meeting, the 12th of March. Any changes? Everybody's happy? So item number 1, the 2014 City of Ottawa Consolidated Financial Statements. We're going to have a presentation on that. And shall we go ahead, Councillor DeRouche? Shall we go ahead with that presentation, then we'll deal with the sinking funds after?
Okay, thank you, Mr. Chair.
Welcome, Ms. Jasmine.
So I have with me today Ernst & Young, our auditors, the external auditors for the audit, Susie Gignac, who's the partner from Ernst & Young, and Darushan Naidu, who was the manager on the audit.
Could we just get you to lean in a bit to the mic or pull it more towards you like that? Thank you.
So I'll go through the financial statements first, and then they will go through the audit results. So first I want to provide an overview of the overall results of the financial statements, some of the key themes that have come out from those financial results. The first one is the liquidity has been maintained. That's really an important measure to look at. That's one that the credit rating agencies look at. And based on the 2014 results, both Moody's and Standard & Poor's maintained our credit rating of AAA and AA plus stable. So we have managed to maintain liquidity throughout 2014 throughout 2014. The employee future liabilities have increased, and I will go through a little bit of detail on that later. But it was primarily due to changes in actuarial estimates and also legislative changes. The net long-term debt was reduced, again, primarily because we did not issue debt in 2014, but we did continue to pay down principal on previous debt. The tangible capital assets are growing. That's primarily due to the light rail project and other projects such as Lansdowne. And then you'll see later on there was a reduction in the revenue compared to previous year, but that also is due to changes in accounting standards and recognition of revenue, not that the overall revenue has gone down. The reserves balance were maintained, and debt servicing continues to be very manageable. Okay. Now I'll go through the consolidated financial statements. And before I do that, I just want to list some of the individual statements that make up what we call the set of financial statements. So first of all, there's a statement of financial position, and that shows the actual overall accumulated surplus or overall equity at a point in time, which is on December 31st, 2014. It includes all our financial assets, non-financial assets, liabilities. It shows the net debt and then accumulated surplus. The statement of operations and accumulated surplus shows for the entire year of 2014 revenues and expenses, and then shows the overall annual surplus for that year. The statement of net debt shows changes in net debt from operations and tangible capital asset transactions. And the statement of cash flows shows a change in cash balances from uses and sources and uses of funds. I will focus on the first two statements throughout this presentation. Before I get into the details, I just wanted to highlight two key terms that are different from what you typically hear from a budget perspective. When we report the financial results from an accounting perspective, there's a term we call net debt, and that's different than what we usually call debt. It represents the financial assets less the total liabilities. And really what it does, it provides a measure of the future revenues that are required to pay for past transaction and events. So the term net debt is shown on the statement of financial position. Next one. The next term I want to talk about is accumulated surplus. Again, this term surplus is a little bit different from when we talk about the surplus from a budgeting perspective. This is calculated from an accrual basis. The budget is calculated on a cash basis. So there's slight differences between what we report in our terms of our surplus from a financial perspective and what we report as a surplus or deficit from a budgeting perspective. The accumulated surplus is as it looks. It's accumulated surplus and deficits from previous years. And included in that is our funds held for reserves, any revenues that are for restricted purposes, and equity in our tangible capital assets. And one last thing I want to talk about is the accumulated surplus increases every year with each surplus, if whatever the annual surplus was reported or the annual deficit, and would go down if it was a deficit. So first I'll start with the statement of financial position, an overall summary. Financial assets are at $2.4 billion, stable compared to previous year. The liabilities are at $3.8 billion, and so if you deduct the liabilities from the financial assets, you get a net debt of $1.4 billion. That's an increase of $176 million from the previous year. The non-financial assets, which primarily is tangible capital assets, increased by $531 million to $13.2 billion. So you have an accumulated surplus of $11.8 billion for the year ended December 31st, 2014. And that's when I talk about the increase from the previous year. It shows our annual surplus that we reported this year. The increase from last year in accumulated surplus is at $355 million. And that represents the annual surplus for the year. Now I'll go into a little bit of detail in each item on the statement of financial position. The financial assets. First of all, there's cash and investments, and those are our cash balances and investment and short-term investments that are easily convertible to cash. In 2014, they're at $1.5 billion. Accounts receivable stayed relatively stable from the previous year. And the last item is the investment in government business enterprises, and that represents our investment in hydro. It represents the net assets, so the value of the net assets of hydro, and shows total financial assets of $2.4 billion. We received this year from Ottawa Hydro, also that we would have shown in our statement of operations, $19.3 million in dividends. Also in the statement of financial position is liabilities. First of all, we have accounts payable and accrued liabilities. Accounts payable is the typical trade payables. In accrued liabilities, you find things that are accrued to the end of the year. So one example is light rail, for example. If we received an invoice, and we did receive an invoice on November 5th for the light rail project, but between November 5th and December 31st, work continued. And so we do an estimation of what that cost was so that we get a full picture of what the cost of the LRT was for the full year of 2014. But that amount that between November 5th and December 31st is what we have to set up as a liability, because they were later invoiced and paid in the following year. So it's an estimation from last invoice to end of year of works done. Included in there too is accrued payroll, for example. So if a pay ended 5 days before the end of the year, we accrue 5 days of payroll. Deferred revenue primarily represents development charges. So when we collect development charges, we don't recognize them as revenue until they're actually used. And so they collect in the deferred revenue as a liability. And then the next two I'll talk about in the next two slides in a little bit more detail. Employee benefit plans. These are future liabilities, and that total has gone up from $489 million to $562 million. Post-retirement and post-employment benefits went up by $25 million. And these are future liabilities, and they represent actuarial estimates of what we think we are going to pay in the future on claims that are currently existing. So if we already have, for example, WSIB claims, we estimate what the future payments will be for those WSIB claims will be, and those estimates are developed by third-party external actuaries that actually calculate the amount that they think is our liability going forward. In the post-retirement and post-employment benefits, there was a change in the actuarial assumption that increased the overall liability by $25 million. For WSIB, it increased by $24 million, and that was primarily a legislative change. They've added new diseases that are claimable, work-related. And in terms of legacy pensions, that increased by $24 million, and that is for the COSF. For the COSF, that was an actuarial loss from last year that we had to recognize this year, this year we actually had a gain that we will recognize next year. So any loss incurred from a pension needs to be recognized in the following year. What's important to note here is that this is a gross number, the $562 million. We also put aside every year a certain amount to fund these future liabilities, and it's held in a reserve, and so far that amount is $69 million. In terms of the debt number, the net long-term debt decreased this year from $1.65 billion last year to $1.56 billion this year. Debt is only used to finance capital assets, so that's important to notice. Note it's not used for operations. And the $1.56 billion is aligned with the long-range financial plans that were approved by Council. The debt level compared to, and you'll see later that our total assets are worth $17.5 billion. So if you compare the $1.56 billion to the $17.5 in total assets, it approximates about 9% of the total cost. So that's quite reasonable. Again, no debt was issued in 2014. And there's two thresholds that we measure ourselves against. Well, there's several, but there's two key ones. One is the tax-supported debt servicing costs as a percentage of own source revenue needs to stay within 7.5%, and currently it's just over 5%, so it's well below the 7.5%. And then there's the provincial limit, which is a total of all debt divided by own source revenue needs to stay within 25%, and that number is actually just over 7%, so that's much below the threshold. In terms of total tangible capital assets, we have $17.5 billion as a total cost, and then the net book value of those assets is $13.2 billion. There was an increase of $775 million in total assets throughout 2014, and that was primarily from LRT, Lansdowne, roads, and water infrastructure. You can see how our total capital assets break down. 30% of it is in water and wastewater. There's linear roads, buildings, assets under construction are included in this number, land, machinery and equipment, so on. I wanted to go into a little bit more detail on the light rail because it did have an impact on our overall capital assets. Overall, the assets under construction for light rail for 2014 was $306 million. Add that to the previous payments to date. Adds up to a total of $935 million. We received government grants of $228 in 2014 for a total of $661. So that represents about 71%. The government grants represent about 71% of the cost of assets under construction to date. And then we also fund it through gas tax, development charges, debt, and own source revenues. This is just a summary of the accumulated surplus, and as mentioned earlier, it includes things like, and it's the biggest chunk of the accumulated surplus is the tangible capital assets at $11.2 billion. We also have reserve and reserve funds, and you can notice that from 2013 to 2014, it increased by about $60 million. We also show our equity in hydro in this number, and then we deduct any future liabilities. So the overall accumulated surplus is $11.8 billion compared to $11.4 in 2013. What's important to note is that the city's equity is increasing. Yep. Next page. Statement of operations. So total revenues were $3.5 billion and total expenses $3.2 for an annual surplus of $355 million. This surplus is different than the one we would have reported in April in terms of budgeted surplus and deficit. In April, we would have reported a $100,000 surplus from tax-supported and $18.8 million deficit from rate-supported. And this annual surplus includes things like amortization expense. It also includes revenues that would not have been included in the budget, like contributed capital. So this is on an accounting or accrual basis, and the budgeted surplus is actually reported on a cash basis. So that's the difference between the two. Going into further detail in the statement of operations, there's the revenue side. So overall, the revenues have declined, primarily in the government transfers and development charges, but that's just in terms of the way the revenue was recognized. Taxes overall have increased, and that represents the increase in property tax and assessments. And fees and user charges have also increased from the previous year. Government transfers, the reason that's slightly lower in 2014 is in 2013 we recognized gas tax that used to be deferred, and due to an accounting change we had to recognize all that previously deferred revenue in that year in 2013. So it bumped up the revenue number in 2013. And then development charges. Development charges aren't recognized when they're collected, they're recognized when they're used. So in 2013 there was a one-time projects where development charges were applied, and one of the biggest ones was Lansdowne. In terms of the overall expenses, the biggest lion's share of the expenses are salaries, benefits, contracts, and materials. 1.6 billion of salaries and benefits, and almost 800 million of contracts and materials, for total expenses of $3.2 billion. You'll notice that the interest charges have stayed fairly stable, and they represent about 3% of the total expenses. So that's the gist of my presentation. There are three key points I wanted to leave you with. The fact that we've maintained liquidity throughout 2014, which is one of those factors that credit rating agencies look at and find is very important. The debt levels are in line with the LRFP, and the accumulated surplus increased from the previous year. I'd also like to thank the accounting team that's behind me. They've put in a lot of time and effort. Their expertise contributed to these financial statements, the quality and the standards that they set puts a lot of faith in those financial statements. Thank you. So I'd like to pass it on to our auditors now.
Did you want to take any questions to that first before we start the audit, or wait till everything?
We can do either.
Okay.
You want to take questions first?
Do any of the committee members have questions on those statements so far? Okay. You want to wait? Do you want to go ahead, Councillor Kluger, or wait?
Just a short question, if I may. Sure. Are we anticipating, one of the increases is in the accrued employee benefits, and part of it is actuarial, which is adjusted, and another 24 million was legislative. Are we seeing any other legislative changes that will have an impact in the future on our liability in terms of post-employment benefits?
There's none that I've seen to date, but one of the things in terms of trends, on average we've increased about 15%, but the province has increased 17%. So there's the changes. I'm sorry. It has been steadily increasing year over year. Most of the changes have been due to the changes in the interest rates this year going down. But in terms of legislative changes, I don't know if Kathy Frederick is here that could maybe answer that question. Yeah, okay.
I think our biggest risk from a legislative point of view is around the WSIB, and Isabel spoke to that in terms of presumptive legislation around cancers. There's also some considerations around stress and post-traumatic syndrome disorder as well. So it is possible that it would hit us more on the WSIB side of things in terms of those types of changes to legislation, which could affect past claims that are on the books right now. But that's the only area that I would suggest there's legislative change. I think what you're also seeing is that the actuarial changes around mortality, people are living longer, the healthcare treatments, the drugs, those are having an impact as well. They're more costly, as well as contributing to longer life as well. That's what's there.
Thank you very much. Just one more clarifying question. On slide 17, you had fees and user charges of 927 million this year for revenue, but on the statement of operations and accumulated surplus, you have fees and user charges for 2014 of 766. Can you just guide me as to what is included in your summary, and where we find it in the consolidated statement?
I believe it also includes other, yes, fees and user charges, fines, and other. So there's other revenue of 34.
The 55 million? So we're looking at 2014 actual, right?
So the 2014 actual, the 26.7 or 26.8 of fines and penalties is also included in that number, and the
55.3 and the 766.9?
Yeah.
They, when added, that's what that is. Okay.
Yeah.
And fees and user charges is 766 million. That is, if you could guide us, that is water, that is transit fees, that is...
It's all the separate user fees.
Are those the two major...
Those are the major ones.
And parks and recreation, of course?
Yes, those are included.
So that's what's in there?
Yeah.
Okay. What is in the other 55 million? Just an example, just to guide us.
So one would be the revenue from lands, sale of lands. That's the biggest chunk in there. The sale of lands. Yeah.
Okay.
And so we had budgeted $6 million for that, and we ended up getting 26. So there was an additional 20 million just in lands.
Okay. Thank you.
Thank you, Vice Chair. Councillor Wilkinson, you had a question?
Yeah, I have a couple of questions that maybe relate to what just was said. It would be good to get them at the same time. If I start on chart 8, you talk about the net debt has gone up quite a bit, but then later on you talk about the, I guess the debt we're paying is 7.16% within our 7.5%, but you also mentioned something about a 5%, and I wasn't quite sure how the two related.
So the 5% refers to the 7.5% limit that we've set as part of the fiscal framework, and that's just on the tax-supported debt. So just when we just look at tax-supported debt and the cost of that debt, it should not, as a percentage of the revenues related to tax, should not exceed 7.5%. The 25% looks at total.
I know what the 25% is. I was only interested in.
Yeah, it's only the tax-supported.
There was a 5% that you mentioned that I was wondering about. You said at 1.5%, and then you said 25%, and then you said 7.16, unless I wasn't hearing it right.
Yeah, so 5% is the total tax-supported debt servicing costs divided by tax revenue.
But then what's
own source revenue.
Oh, that's all revenue. So the 7.16.
It doesn't include rate revenue. That particular calculation doesn't include rate revenue.
The 5% doesn't. Okay. Yeah. I think we have to include the other because it's all.
So that's the 7% is the total.
Okay. That clarifies that. The question that was just asked about the on slide 10. The answer saying that the liabilities are increasing. Are we putting enough in each year if they're increasing so that we don't end up one year having a huge cost because the amount we've got in the reserve would not be enough to cover it? I'm just wondering if anybody has looked at that over the time frame of when those obligations will likely come due, and if we're going to have in 5 or 10 years or whenever a huge problem because we haven't put enough into this. I think you said you put 69 million or something in this year. Is that enough to keep that flow?
So, Mr. Chair, what we do is every year we budget the annual amount that is included in our budget. So what our annual costs are already accounted for yearly, and then what we're doing in terms of the reserves is just funding for potential future fluctuations. But every year we budget an amount of what is required that year.
Right, but if you actually had a very, very large amount in some year, that would be just destroy the whole budget effectively, because it can. Then you have that reserve to use. And I just was wondering, has anybody done a look at that whole thing to get a good picture of it? And that's even over to our finance people and to you.
Ms. Jasmine is finance, and yeah, we have looked at that. We have got forecasts going forward with respect to what we think the usage is going to be and how much, because this is all determines how much that $69 million, how we can invest it, because we have to know if we are going to draw on it in the short term or if it's we can use a longer term investment vehicle, because we don't think we're going to need it for a number of years. So yes, we've done all of that analysis. Our actuaries actually have to do it as in coming up with those numbers. They have to do a forecast of when they think those expenses are going to occur.
And you use that then to determine how much to put in each year so you don't get any big hiccups in the future?
That's correct. We adjust it every year in the budget to make certain that there's sufficient funds to deal with the expenses in the year. The big amount that we have set aside is actually for the long-term disability program. A number of programs we don't have money set aside, and that was a decision that Council made. For example, WSIB costs, we fund those in the year. So if there's a big increase in WSIB costs, that will be in your budget in the next year. So some things are covered from that reserve, other things, no. We are running with that simply through adjustments in the budget.
So from a financial point of view with the WSIB then, which could be, with the new changes, could become a major cost in the future and impact on our ability to do other things.
It would be added on to, and I can tell you that this year we're already seeing some pressure in that area. It'll be added on to as part of the budget for 2016 to adjust those accounts to bring them up.
Right, but if you do that and we have a limit that we can raise in taxes, we then have to put something else away.
That's correct.
Okay, we've got to keep an eye on that then. Thank you. The last one I wanted to ask right now is because which really was on the WSIB, the risk, because I really just sort of added with that question. I think that, Mr. Chair, that's something we do have to keep an eye out for, because it's not going to hit us probably for 2 or 3 years, but in 5 or 10 years it could become a huge issue, and has for some municipalities that didn't have any reserves. This problem has been around for a long time. I remember dealing with it 30 years ago, so it's not a new problem.
Thank you very much. It's a good point. Councillor DeRouche, you had a question as well?
Thank you, Mr. Chair, and thank you for your presentation, Isabel. I have a question around the legacy pension. And the legacy pension, in my understanding, it's an old contract or an old... so I can't wrap my head around how it's 24 million. It goes from one year to another. Can you a little bit clarify?
Sorry, I didn't catch the tail end of the question.
The legacy pension?
Yes.
It went from 15 million to 39 million.
Yes.
It's 24 million difference. Can you clarify how come this happened? Legacy pension, from my understanding, it's an old contract, isn't it?
Yes. So it was changes in actuarial assumptions, and so that pension, both of those pensions are closed. The OC Transpo pension still has active employees, but the COSF, which is the City of Ottawa's superannuation fund, has no more active employees. It's just retirees. For that one, there was an actuarial loss based on actuarial calculation, and we recognized that loss this year from last year. This year, it was actually a $14 million gain, so that gain we will recognize next year.
Okay, thank you. There we go. Sorry. I just have a follow-up comment, too, on the debt piece. On slide page 8, sorry, it shows net debt going up, but several different pieces through there, you're saying the net debt's going down.
So the total debt, the net long-term debt, which is different than the net debt. Net debt is financial assets less all liabilities. Mm-hmm. The debt is what we've issued in terms of debt, and also includes mortgages and capital leases. So when we talk about the debt, it's what we've issued in terms of debt. When we talk about net debt, it's our financial assets less all our liabilities. And what it represents is what needs to be covered by future revenues. So it's almost showing our financial position from a financial perspective, not what we've issued in terms of debt.
Okay. And the 7.16% of that our debt represents, you were saying is very good as compared to the provincial maximum of 25%. Yes. Any idea where we sit as comparison to other municipalities? Are we actually very good in that percentage, or is that about average?
We did look at the 2013 numbers, which are the ones that are most recently published, and we are one of the lowest debt per capita of the large municipalities nationally.
Thank you. Okay, did you want to start the audit presentation? Thank you.
All right, thank you, Mr. Chair. We'll just take a few minutes to walk you through the results of our audit and any changes to our strategy that took place during the year. All right, so if we just maybe move through to page 2 of the slide deck, we'll just give you a high level of the services we perform. So we are engaged to express an opinion on the financial statements as at and for the year ended December 31st, 2014. In addition, we do some audit work on other financial information for related entities within the City of Ottawa. We will issue a written communication and management letter with respect to observations and recommendations on processes if we deem it's necessary, and we also issue a letter attesting to our independence, which you'll actually find in the more fulsome audit results document. If we look at the status update column, the items in that status update column are quite common at this point in the audit. We don't actually sign off on our audit opinion until the date when Council approves the financial statements, so we do have to conduct our audit procedures up to that date. So we will, at that point in time, obtain a letter of representation from management that will be circulated to the committee before it is finalized. We will perform final audit procedures, including subsequent events review up to the date of our audit, and standard fraud and subsequent event inquiries as well, and we'll get evidence of approval of the statements from Council. Other services we perform include that we translate the French consolidated financial statements, and that will happen prior to them being published, but has not taken place as of yet. We move on to slide 3, talk a little bit about our audit strategy and whether there's been any change in our strategy. So we do look at entity level controls, which are those controls at a high level within the organization that are then cascaded through the organization, things like the code of conduct, the fraud and waste hotline, the tone at the top, and we did conclude that the entity level controls within the city were effective for purposes of our audit. We also, in a more detailed level, from a strategy perspective, we determine whether we're going to be able to rely on controls within the city, and then we do also some detailed substantive testing. So, as we expected in our plan, we did rely on controls over the accounts payable, the expenditures, and the payroll process. We also did IT general control work on the SAP system, which looks at system changes, access to the system, etc., and we were able to rely on that system. In addition, this year, added to our strategy, we looked at the IT general controls over the MarkView system, and we were also able to rely on that system. And then we also did some detailed substantive testing of specific transactions within the city. When we issue our opinion, we issue an opinion that the financial statements are fairly presented in all material respects in accordance with public sector accounting standards. Materiality is the magnitude at which a misstatement or an omission within the statements could be reasonably considered to affect the economic decision of a user. So at the beginning of the audit, we presented in our audit plan that our materiality would be set at 1.5% of expenditures. At that point in time, it was approximately $43 million, but expenditures were higher in the final financial statements. So our materiality, we kept it at 1.5%, which was $47.7 million. We do testing at thresholds much below this level. We do testing of what are called key item transactions, which can be as low as 5% of materiality down to about 2.5 million. And we also do random testing so that any transaction can get picked up in the population. We then assessed the unadjusted differences, which I'll talk about in a minute, within the financial statements, and we assess whether from both a quantitative and a qualitative perspective, we feel that the financial statements are fairly presented in all material respects. And we take not only the materiality number into consideration, but also qualitative factors into consideration, which include things like whether the errors are indicative of any type of fraud, what impact they have on specific line items, subtotals, or totals. And we concluded at this point that we anticipate issuing an unmodified opinion, and we feel that the uncorrected differences identified during the audit are not considered material to the financial statements. As part of our strategy, we also indicated that we would use specialists, and we did do that, in particular around employee future benefits. We do have internal actuaries who review the work of the city's actuaries to make sure the assumptions are reasonable and that the liabilities as recorded are appropriately presented. So I'll move on to the areas where we put particular audit emphasis for the city's financial statements. We do put particular emphasis on revenue recognition. We perform walkthroughs of the processes. We look at the various streams of revenue, so that would include both the property taxes, the user fees, the government transfers, so all of those streams. And we do detailed testing against agreements and specific property tax information. And we, based on the procedures performed, we didn't identify any significant differences in this area. We put a fair amount of focus on tangible capital assets as well. It's a fairly large balance within the financial statements, and it was only in 2009 that the city started to record tangible capital assets on their financial statements based on the public sector accounting standards. So we look at the additions and the disposals and the amortization and get audit comfort over those transactions and processes. We also, given the size of the Ottawa Light Rail Transit project, did look particularly at that agreement last year and again this year, and we've concluded that the city's treatment of those costs appears reasonable. In our work on tangible capital assets, we did identify some uncorrected differences, which we will discuss in a minute. Other areas of audit emphasis include the valuation of investments and financial instruments. Here we do confirm that the investments exist, and we look at the valuation, and we actually do independent testing of the valuation of those investments included in the financial statements. We focus on the measurement of employee future benefits. As I mentioned, we have our internal actuary who reviews the work of the city's actuary. We look at the completeness of contingent liabilities and accruals related to those figures. The city is a party to a number of legal proceedings, and we have both in-house and external legal counsel who provide confirmation the status of those claims, and then from there we can determine that the accruals are appropriate. And we look as well at the disclosure of commitments. Based on those procedures, we did identify one difference related to employee future benefits, which again I'll discuss in a moment. So moving into the unadjusted differences, which we wanted to bring to your attention. With respect to tangible capital assets, we did identify uncorrected differences, particularly related to the amortization, the timing of amortization of those assets and of disposals. And we noted that there was an overstatement of that balance of approximately $47.1 million on the total balance of $13.2 billion. We did then consider our materiality and whether those would be material to the financial statements. We look at the fact that the overstatement is approximately 0.3% of the balance. It's not significant to the line item. We take into consideration that it was not indicative of any type of fraud or anything to that effect, and that it doesn't have a significant impact on key ratios of the city, and for that reason we concluded that we did not believe that the uncorrected difference was material to the statements. Employee future benefits. For a number of years we've held this difference on our summary of audit differences, in particular for the superannuation fund. The members of that plan, the City Council has agreed to index the payments for that plan, and we have recorded on our summary of differences the value of that indexation. While there is no legal liability for the City to continue to provide that indexation, under the standards there is something called a constructive obligation that we feel would warrant that this liability should be recorded. The amount is approximately $15.6 million, which is not considered material to the financial statements. We then look at the errors as a whole and how they impact the statement of operations, and the net impact of the errors that were not corrected is an understatement of the annual surplus of $48 million. This is primarily related to tangible capital assets as well, and in particular assets that were recorded on the statement of financial position at the end of last year but should have been disposed of in a prior year. So in the current year, the City disposed of those assets in order to accurately reflect its tangible capital asset balance with respect to those amounts. But as a result, in order to write it off, it had to go through the statement of operations in the current year and resulted in an understatement of the surplus of $48 million. Again, we looked at that from a materiality perspective to determine if we were comfortable with it. Our materiality was $47.7 million, with this error being $48 million. This error represents 1.52% of expenditures versus our planning materiality of 1.5%. It was not indicative of fraud, and it was the correction of a prior period error. It doesn't have any impact from our understanding on compensation plans, and so as a result we felt that while it is slightly above our planning materiality, when we take both the quantitative and the qualitative factors into consideration, we did not feel that it resulted in a material difference in the financial statements, and we anticipate issuing an unmodified opinion. We do, however, also anticipate this year issuing a management letter with respect to tangible capital assets and the accounting for those assets and how the financial impacts are accounted for in the financial statements. And that I'm happy to answer any questions.
There we go. Thank you very much. Does anybody have any questions to Councillor Cloutier or Vice Chair?
Thank you, Chair Hubley. Your name?
Sorry, Susie Janak.
Okay. Are there, in layman's terms, any elements of concern that my council colleagues, that you would like to bring to the attention of my council colleagues?
Yeah, I mean, I would say that in general, we have very good support from management, and the financial statements we believe are reasonably stated. The areas where we feel some focus needs to be placed are in the accounting for the tangible capital assets in particular, that maybe some processes need to be in place to appropriately account for additions and disposals and amortization at the correct period. And that's where we found most of the differences in the financial statements.
So in the treatment, non-cash treatment of tangible assets, does that summarize?
Essentially, it's how they're recorded on the financial statement. So when should they be moved from assets under construction to an asset in use and then depreciated so that impact goes through your statement of operations at the appropriate time?
Yeah, sometimes just referred to as timing differences.
It could be, absolutely.
Yeah.
Yep.
Okay.
Yep.
The COSOF, the $15.6 million understatement of the pension liability, is that a matter of policy of the city that it wasn't recorded, and that as auditors you'd like to see that 15.6 million recorded, or has that been not recorded in the past, or was it just an omission this year?
So it has never been recorded, and essentially there is some judgment in what actually represents a constructive obligation, which is when you don't actually have a legal obligation for the liability. However, you've been doing it for so many years that it would be very difficult to take it away, and that maybe the city has actually lost discretion to pull that indexation away from the members that are currently receiving it. And in our judgment, we felt that that represented a constructive obligation that should be recorded as a liability. But as there is some judgment there, I don't believe the city has recorded it at this point.
Thank you. Thank you, Chair.
Councillor Wilkinson?
Yeah, you did indicate you're going to do a management letter, though, on these. And so what would you be putting into that management letter that would be for our staff to deal with these issues that you've raised, which you say are not really material, but they're a little bit larger than they should be?
So we are in process of drafting the management letter at this point, but some of the things that we believe might be helpful or we would likely recommend would be standardized forms for when assets are put into use. So at the point when a project manager determines that an asset is ready for use, there's a standardized form which then moves it into production, and then amortization would commence, and then the finance department would be aware, therefore, that it should move the asset and start to amortize that asset. It would include then review of information, so in particular in the assets under construction balance, an annual review, or actually a regular review, probably more than annually, of what's in that balance and whether that does represent capital assets or whether those assets should actually be expensed. That should be happening on a regular basis, and would hopefully eliminate the issue of disposing of assets in the wrong period. So those types of things would be what we would be putting forward.
Do you think this is partly because this is a relatively new way of doing financial statements for municipalities with the capital assets? And is this partly a learning curve of how you handle the details?
Yeah, I would say that it is. Yeah.
So it was really, what you were explaining was really more a process within the administration of how you deal with these to move from building an asset or destroying or whatever you do with it into the financial department.
Yes.
Okay, so that's really more, I think, Mr. Kirkpatrick's realm, is it not? Anyway, the management letter will make that clear, and I think we would like to see how that goes forward. I see it's not a huge problem now, but if it's not corrected, I think it could become bigger in the future. Thank you.
I'm not concerned about it, but if you'd like us to, the Treasurer to respond.
Well, I'd wait till the management letter comes and just let us know how you're dealing with it. I think would be adequate. If the Chair considers that okay. Yeah.
Thank you, Councillor Wilkinson. Anybody else? Okay, so reports received. Carried. Thank you very much. Thank you for your presentations. So item number 2 is the sinking fund financial statements, and I don't believe we were getting a presentation, or are we? No? Okay. Does anybody have any questions, or I have one on this. Does anybody else have one? Or? Okay. Not sure, Madam Treasurer, who can answer this, but on page 2 of the report, it shows that the balance is $74.59 million on an amortized cost basis with a market value of $80.43 million. And it says the actuarial requirements are $71.98 million, which is the minimum amount required. Can you give us some context on that? Is that good that we're that close to the minimum? Is it fantastic that we're that much over the minimum? I just want to get some context to those numbers.
So it's all good.
Gee, thanks.
No, you do an actuarial evaluation to say what you should have in it based on the fact, because these are sinking funds. You don't pay these principal amounts off every year. You pay them off in balloon payments, usually at the 10-year or 20-year or 30-year mark. So you have to be putting money aside every year for it. But of course, it earns interest. And so we do an assessment, or the actuaries do an assessment. Actually, I don't think we use actuaries for this. But we do an assessment of where we're at this point in time, and where we think we should be at. And in this case, so the minimum value was set at the 71.98, but on a cash basis, we're at 74, so we're ahead. So that's why we're actually recommending the reduction in the contribution of 2.6, I think it's 2.6 million. 2.86 million, because you're already ahead of where you need to be, so you can reduce how much you're contributing to the sinking fund reserve and use those funds for other things, which we have done already in the 2015 budget.
So even though the commitment is $761.84 million, and I am reading these numbers, not memorizing them, we're still okay even at like 10% of that?
Oh, definitely, because don't forget, I think the end date for some of these payments are...
2053.
2053. So based on the fact that you have a big payment due in 2053, yes, you've got enough, you've got more than you need right now in those sinking fund reserves.
I just worry that future councils may not be as fiscally responsible as this council, so I want to make sure we're putting the money away.
You get these every year. We always make the adjustments, and we have never... been impacted negatively from a sinking fund in the history of this city.
And we're going to keep it that way.
That's true.
Thank you very much for your answers. The report, if there's no other questions, received, carried?
Received, carried.
Perfect, thank you. Then we have, does anybody have any in-camera items? No? We're good. Notice of motions for consideration at subsequent meetings? Yeah, we're good. Inquiries? We're on a roll. Other business? Who would like to move a motion to adjourn?
Motion to adjourn.
Vice Chair, thank you. And our next meeting will be, actually this says next meeting May 28th, so that's not quite accurate. It's June 12th. And, sorry, June 15th. Would the Auditor General like to say anything about that meeting? Would you like to say anything about that meeting, or we'll just stay tuned for the agenda? It's going to be an exciting meeting. How about we just say that? Okay. Thank you all.